Wealth Wisdom for Starters. Simple Steps to Managing Your Money. Written by Ronnie Rowland. Published by Growth Literacy Lounge. Introduction. What does true financial freedom look like to you? Imagine waking up each morning knowing you have the financial stability to pursue your dreams, support your loved ones, and confidently navigate life's uncertainties. Picture a life where you control your money, and not vice versa. This is the essence of financial independence, a state where financial stress is a distant memory and your financial future is secure. In today's fast-paced world, achieving financial independence might seem daunting. Many are caught in a cycle of debt, living paycheck to paycheck and feeling overwhelmed by the complexity of personal finance. But what if I told you that transforming your financial situation is possible and can be accomplished through straightforward, actionable steps? Welcome to Wealth Wisdom for Starters. Simple Steps to Managing Your Money. This book is designed to demystify the world of personal finance and equip you with the tools to take control of your financial destiny. Whether you're just starting your financial journey or looking to refine your money management skills, this guide offers practical strategies and insights to help you achieve lasting financial well-being. Why is financial literacy the key to unlocking your financial potential? Financial literacy, the ability to understand and use financial skills effectively, is the foundation of financial independence. Without it, even the best financial strategies can falter. This book begins by laying a solid groundwork of financial knowledge, covering the basics of budgeting, saving, investing, and debt management. Each chapter builds upon the last, creating a comprehensive roadmap to financial empowerment. As you progress through the chapters, you'll discover that financial independence is not just about accumulating wealth, but about making informed choices that align with your values and long-term goals. You'll learn how to create a budget that works for you, build a robust savings plan, invest wisely, and manage debt effectively. You'll also gain insights into protecting your assets, planning for retirement, and teaching financial literacy to others, ensuring that you and your loved ones are financially secure for future generations. How can this book transform your financial journey? The journey to financial independence is unique for each individual, but the principles outlined in this book are universal. They are designed to inspire, motivate, and guide you toward making proactive financial decisions. By embracing these principles, you can break free from financial limitations and create a life of abundance and security. Start small, but start now. Even the most minor steps can lead to significant changes over time. The key is to be consistent and stay committed to your financial goals. Remember, you have the power to change your financial future. It begins with a single step, a decision to take control and pursue financial independence with determination and confidence. As you embark on this transformative journey, remember that financial independence is not a destination but a continuous learning, adapting, and growing process. This book is your companion on that journey, providing the knowledge, tools, and encouragement you need to succeed. Let's begin this journey together and take the first step toward a future of financial freedom and peace of mind. Join our vibrant community of seekers and learners by subscribing to the channel. Every subscription is a token of encouragement that fuels our ability to bring you more captivating and thought-provoking content. Comment and like. Become part of the movement shaping the future of learning and growth. Let's begin. Chapter 1. The Foundations of Financial Literacy. What does it mean to be financially literate? Financial literacy is the cornerstone of economic independence. It is understanding and applying various financial skills, including personal financial management, budgeting, and investing. Without a solid grasp of these basics, even the most well-intentioned financial plans can crumble. Imagine you're building a house. Before decorating or choosing furniture, you need a solid foundation to ensure the structure is sound. Financial literacy works the same way. It forms the bedrock upon which all other financial decisions are made. Why is understanding financial basics crucial? To navigate the financial world effectively, you must understand critical concepts such as income, expenses, assets, and liabilities. Let's break these down. Income. The money you earn from various sources, including your job, investments, and side hustles. Expenses are the money you spend on necessities and luxuries, from rent and groceries to dining out and entertainment. Assets. You own valuable items such as your home, car, savings, and investments, which can provide future economic benefits. liabilities, debts, or financial obligations you owe, like mortgages, student loans, and credit card debt. By grasping these concepts, you can better understand your financial situation and make informed decisions. How can tracking your income and expenses change your financial outlook? The first practical step in achieving financial literacy is to track your income and expenses. This habit helps you see where your money is going and identify areas to reduce or reallocate funds. Use apps, spreadsheets, or even a simple notebook to record every dollar you earn and spend. Practical tip: set aside time each week to review your financial records. This regular check-in can help you stay on top of your finances and make necessary adjustments. What impact does distinguishing between assets and liabilities have on your financial decisions? Understanding the difference between assets and liabilities is crucial. Assets put money in your pocket, while liabilities take money out. For example, owning a rental property can generate income, making it an asset. Conversely, a high-interest credit card debt is a liability, because it requires regular payments that deplete your income. You can build a stronger financial foundation by acquiring assets and minimizing liabilities. Remember, everyone starts somewhere. Financial literacy is a journey, not a destination. No matter how small, each step you take brings you closer to financial independence. How does financial literacy empower you to make better financial decisions? With a solid understanding of financial basics, you can make more informed and confident decisions about your money. Whether creating a budget, planning for retirement, or investing in the stock market, financial literacy equips you with the knowledge to navigate these areas successfully. Think of financial literacy as a toolkit. The more tools you have, the better equipped you are to handle any financial situation that comes your way. Assess your financial knowledge. Take a few minutes to assess your current level of financial literacy. Answer the following questions honestly. Do you know how much money you earn and spend each month? Can you differentiate between your assets and liabilities? Do you have a basic understanding of budgeting, saving, and investing? Are you familiar with the interest rates on your debts? If you find gaps in your knowledge, don't worry. This book is here to help you fill them and build a solid financial foundation. How will building financial literacy transform your life? Financial literacy is not just about managing money, it's about gaining control over your life and future. It empowers you to set realistic goals, make informed decisions, and achieve financial security. As you continue reading, you'll build on this foundation, gaining deeper insights and practical strategies to enhance your financial well-being. Embrace this journey with an open mind and a willingness to learn. Financial independence is within your reach, starting with understanding the basics. The next chapter will dive into budgeting your financial blueprint. You'll learn how to create and stick to a budget that works for you, setting the stage for economic stability and growth. Chapter 2. Budgeting your financial blueprint. What if budgeting could transform your financial life? Budgeting is not about limiting your freedom but empowering yourself to make informed financial choices. Think of a budget as your financial blueprint. It provides a clear plan for your money, allowing you to prioritize spending and achieve your financial goals. Why is creating a budget essential for financial stability? A budget helps you understand precisely where your money goes each month. It enables you to allocate funds for necessities, set aside savings, and manage discretionary spending. Without a budget, it's easy to lose track of expenses and live paycheck to paycheck. Start by listing all sources of income and categorizing your expenses. This process gives you a comprehensive view of your financial situation and highlights areas where you can adjust. Practical tip: use the 50-30-20 rule as a simple budgeting guideline. Allocate 50% of your income to needs, housing, utilities, groceries, 30% to wants, dining out, entertainment, and 20% to savings and debt repayment. This approach helps balance essential expenses, lifestyle choices, and future planning. How can you effectively categorize your expenses? Distinguish between needs and wants to create a realistic and sustainable budget. Needs are essential for survival and daily functioning, while wants are non-essential items that enhance your lifestyle but aren't crucial. For example, needs: rent, utilities, groceries, transportation, insurance, minimum debt payments. Wants: dining out, entertainment, hobbies, travel, luxury items. By categorizing expenses, you can identify areas where you might be overspending and make necessary adjustments to align with your financial goals. Budgeting doesn't mean depriving yourself of the things you enjoy. It's about making mindful choices that reflect your priorities and values. How does sticking to a budget empower you? Adhering to a budget gives you control over your finances. It reduces financial stress, helps you avoid debt, and allows you to save for future goals. Moreover, it provides a sense of accomplishment as you see your savings grow and your financial health improve. Think of your budget as a roadmap guiding you toward financial stability. Each step you take, whether cutting back on unnecessary expenses or saving a little more each month, brings you closer to your financial goals. Practical exercise. Create your budget. Follow these steps to create your budget. List your income. Include all sources of income, such as your salary, freelance work, and passive income. Track your expenses. For 1 month, track every expense to understand your spending habits. Categorize these expenses into needs and wants. Set financial goals. Define short-term and long-term goals. Short-term goals might include saving for a vacation, while long-term goals could be buying a house or retirement planning. Allocate funds. Use the 50-30-20 rule to allocate your income to needs, wants, and savings debt repayment. Monitor and adjust. Regularly review your budget and make adjustments as needed to stay on track. Practical tip. Use budgeting tools and apps to simplify the process. They can help you track expenses, set goals, and monitor your progress. How can reviewing your budget regularly ensure success? Life is dynamic, and your financial situation can change due to various factors like a job change, a new family member, or unexpected expenses. Regularly reviewing and adjusting your budget ensures it remains relevant and effective in helping you achieve your goals. Don't be discouraged if you need to make adjustments. Flexibility is critical to maintaining a realistic and sustainable budget. The important thing is to stay committed to your financial goals. How does a well-planned budget set the stage for financial growth? A well-planned budget is the foundation for all other financial activities, such as saving, investing, and debt management. It provides the structure and discipline to make informed decisions and pursue economic growth. View your budget as an essential tool for achieving financial freedom. It empowers you to manage your money, make proactive decisions, and build a secure financial future. How can budgeting foster a positive financial mindset? Budgeting encourages a proactive approach to money management. It shifts your mindset from reactive to proactive, enabling you to anticipate expenses, plan for future needs, and make strategic financial choices. Embrace budgeting as a positive step toward financial empowerment. Taking control of your finances creates opportunities for growth and success. Practical exercise. Evaluate your spending habits. Reflect on your spending habits over the past month. Ask yourself, did I spend more on wants than needs? Were there any unexpected expenses, and how did I handle them? Am I on track with my savings and debt repayment goals? Use these insights to make informed adjustments to your budget, ensuring it aligns with your financial goals and priorities. Creating and sticking to a budget is a decisive step toward financial stability and growth. It provides a clear plan for your money, enabling you to make informed decisions and achieve your financial goals. By understanding and categorizing your expenses, setting realistic goals, and regularly reviewing your budget, you empower yourself to take control of your financial future. Budgeting is not a one-time task but an ongoing process. Stay committed, be flexible, and remember that each step brings you closer to financial independence. In the next chapter, we'll explore the importance of saving and how it contributes to a secure financial future. You'll learn practical strategies to build and maintain a robust savings plan, ensuring you have the resources to handle life's uncertainties and achieve your long-term goals. Chapter 3. Saving for a Secure Future. Why is saving money more important than ever? In a world of economic uncertainties, having a savings cushion is crucial. It provides financial security and peace of mind, enabling you to handle emergencies without falling into debt. Saving is about putting money aside and prioritizing your future well-being and economic independence. How can setting specific savings goals motivate you? Setting specific savings goals gives the purpose and direction of your saving efforts. Whether building an emergency fund, saving for a vacation, or planning for retirement, having clear goals makes saving more meaningful and motivating. Start by defining your short-term and long-term savings goals. Short-term goals could include saving for a new gadget or a holiday trip, while long-term goals might involve buying a home or retiring comfortably. Having a mix of both keeps you motivated and focused. Practical tip: please write down your savings goals and place them somewhere visible, like your fridge or office desk. This constant reminder will help you stay committed to your savings plan. How can automating your savings simplify the process? Automating your savings is one of the most effective ways to ensure consistency. Set up automatic monthly transfers from your checking account to your savings account. This way, saving becomes a regular habit, and you are less tempted to spend the money. Practical tip: choose a specific day each month for the automatic transfer, preferably right after you receive your paycheck. This strategy ensures that saving is a priority and not an afterthought. Why is building an emergency fund essential? An emergency fund is a financial buffer against unexpected expenses, such as medical emergencies, car repairs, or job loss. It prevents you from falling into debt when life throws a curveball. Aim to save 3 to 6 months' living expenses in your emergency fund. This amount provides a comfortable cushion to handle most emergencies without financial strain. Practical tip: keep your emergency fund in a separate, easily accessible account, such as a high-yield savings account. This separation ensures you don't dip into it for non-emergencies and allows it to earn interest. How does an emergency fund provide peace of mind? Knowing you have a financial safety net reduces stress and allows you to focus on other financial goals. It provides the confidence to take calculated risks, such as investing or starting a business, knowing you have a backup plan. Think of your emergency fund as a security blanket. It protects you when you need it most, giving you the freedom to pursue your financial aspirations confidently. What role does saving play in achieving financial independence? Saving is the foundation of financial independence. It allows you to accumulate wealth over time, providing the resources to invest in opportunities to grow your wealth further. By consistently saving, you build a financial cushion that supports your long-term goals and dreams. Saving is like planting a tree. It may take time to see the results, but it will grow strong with consistent effort and provide benefits for years. Start your savings plan. Follow these steps to kickstart your savings plan. Set clear goals. Define your short-term and long-term savings goals. Be specific about what you want to achieve and by when. Create a budget. Review your budget to identify areas for reduction and reallocate funds towards savings. Automate savings. Set up automatic transfers to your savings account each month. Monitor progress. Regularly check your savings progress and adjust as needed to stay on track. Practical tip: consider opening multiple savings accounts for different goals. This approach helps you stay organized and track progress toward each goal separately. How can small savings grow over time? Thanks to the power of compound interest, even small savings can grow significantly over time. Starting early and saving regularly can build a substantial financial cushion. For example, saving just $100 monthly at an interest rate of 5% compounded annually can grow to over $15,000 in 10 years. The key is consistency and allowing your savings to grow over time. Remember, it's never too late to start saving. The key is to begin and stay consistent. Every little bit you save today brings you closer to financial security tomorrow. How does saving contribute to a wealth wisdom mindset? Saving instills discipline and foresight, crucial components of a wealth wisdom mindset. It teaches you to prioritize your future needs over immediate gratification and builds the habit of making prudent financial decisions. Think of saving as a journey, not a destination. Each step you take, no matter how small, moves you closer to your financial goals and a secure future. Practical exercise. Evaluate your savings habits. Reflect on your current savings habits. Are you consistently saving each month? Do you have specific savings goals? Is your emergency fund sufficient? Use these questions to assess your progress and identify areas for improvement. Adjust your savings plan as needed to align with your financial goals. Saving for a secure future is a crucial step in achieving financial independence. You create a solid financial foundation by setting specific savings goals, automating your savings, and building an emergency fund. Remember, the journey to financial security is a marathon, not a sprint. Stay committed, be consistent, and celebrate your progress along the way. Every dollar you save today is an investment in your future. Embrace the habit of saving, and watch your financial security grow. In the next chapter, we'll explore smart investing, making your money work for you. You'll learn about different investment options, strategies to diversify your portfolio, and the principles of successful investing, ensuring you can grow your wealth and achieve financial independence. Chapter 4. Smart Investing, Making Your Money Work for You. How can investing accelerate your path to financial independence? Investing is a powerful way to grow wealth over time, allowing your money to work for you. While saving is essential, investing takes your financial strategy to the next level by generating returns that can significantly boost your financial health. Putting your money into assets you can appreciate creates additional income streams, contributing to your long-term financial goals. What are the basics of investing? Before diving into the world of investing, it's crucial to understand the basic concepts and types of investments. Here are the key terms and their definitions. Stocks. Shares of ownership in a company. When you buy stocks, you become a part owner of that company and can benefit from its growth and profits. Bonds. Loans you give to companies or governments. In return, they pay you interest over a specified period. Mutual funds. Investment vehicles that pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. Index funds. A type of mutual fund designed to track a specific market index, like the S&P 500. They offer broad market exposure and typically have lower fees. Real estate. Investing in property to generate rental income or to sell at a higher price in the future. Practical tip. If you are new to investing, start with low-cost index funds. They offer broad market exposure and lower fees than actively managed funds, making them ideal for beginners. How does diversification reduce investment risk? Diversification involves spreading your investments across asset classes and sectors to reduce risk. Not putting all your eggs in one basket mitigates the impact of poor performance in any single investment. For example, if you invest only in technology stocks, a downturn in the tech industry could significantly impact your portfolio. However, if you also invest in bonds, real estate, and other sectors, the positive performance of those investments can offset the losses in the tech sector. Practical tip. Aim to diversify your portfolio by including a mix of stocks, bonds, and other assets. Consider using mutual funds or index funds to achieve diversification with ease. What are the principles of successful investing? Successful investing requires patience, discipline, and a long-term perspective. Here are some fundamental principles to guide you. Start early. The sooner you start investing, the more time your money has to grow. Thanks to compound interest, even small investments can grow significantly over time. Be consistent. Regularly contribute to your investments, regardless of market conditions. This approach, known as dollar-cost averaging, reduces the impact of market volatility. Stay informed. Keep yourself informed about market trends and the performance of your investments. This knowledge helps you make informed decisions and adjust your strategy as needed. Avoid emotional decisions. The market can be volatile, and making impulsive decisions based on short-term fluctuations is easy. Stick to your long-term plan and avoid making emotional decisions. Think of investing as a marathon, not a sprint. It requires time and patience, but the rewards can be substantial. Stay committed to your strategy and let time work in your favor. Practical exercise. Begin your investment journey. Follow these steps to start investing. Set clear goals. Define your investment goals, whether it's for retirement, buying a home, or building wealth. Determine risk tolerance. Understand your risk tolerance based on your financial situation, goals, and comfort level with market fluctuations. Choose an investment account. Open an investment account, such as a brokerage or retirement account, like an IRA or 401k. Select investments. Choose a mix of stocks, bonds, and other assets based on your goals and risk tolerance. Consider starting with low-cost index funds. Monitor and rebalance. Regularly review your portfolio and rebalance it to maintain your desired asset allocation. Practical tip: consider consulting a financial advisor to help you create a personalized investment plan and ensure you are on the right track. How can understanding investment fees impact your returns? Investment fees can significantly impact your returns over time. High fees can erode your gains, while low-cost investment options allow more of your money to grow. Be aware of various fees, including management fees, transaction fees, and expense ratios, and choose investments with lower costs. Practical tip: compare the expense ratios of mutual funds and index funds before investing. Opt for those with lower fees to maximize your returns. How does staying the course benefit your investment strategy? Sticking to your investment plan, especially during market volatility, is crucial for long-term success. Markets will have ups and downs, but maintaining a long-term perspective and avoiding knee-jerk reactions can lead to better outcomes. Stay focused on your long-term goals. Market fluctuations are expected, and staying invested through the highs and lows is often the best strategy. How does investing align with a wealth wisdom mindset? Investing is a critical component of a wealth wisdom mindset. It reflects proactive financial planning, discipline, and a commitment to long-term growth. By making informed investment decisions, you take control of your financial future and work towards achieving financial independence. View investing as a journey towards financial freedom. No matter how small, each investment decision contributes to your overall financial well-being and brings you closer to your goals. Practical exercise: review your investment strategy. Evaluate your current investment strategy and ask yourself, are my investments aligned with my financial goals? Am I diversified across different asset classes? Do I understand the fees associated with my investments? Use these questions to refine your strategy and ensure it supports your long-term financial objectives. Investing is a powerful tool for building wealth and achieving financial independence. By understanding the basics of investing, diversifying your portfolio, and adhering to the principles of successful investing, you can make your money work for you. Remember, investing requires patience, discipline, and a long-term perspective. Stay informed, stay committed, and let time be your ally in growing wealth. Every investment you make today is a step towards a more secure and prosperous future. Embrace the investing journey and watch your financial dreams become a reality. The next chapter will explore strategies for managing debt and regaining control of your financial life. You'll learn to differentiate between good and bad debt, create a repayment plan, and strategically use debt to achieve your financial goals. Chapter 5: Managing Debt, Regaining Control. How can you turn debt from a burden into a manageable part of your financial strategy? When appropriately managed, debt can be a tool rather than a burden. It allows you to leverage resources for essential investments, such as education, home ownership, or business. However, when mismanaged, debt can quickly become overwhelming and detrimental to your financial health. The key is understanding the difference between good and bad debt and developing strategies to manage both effectively. What is the difference between good debt and bad debt? Good debt is an investment that will grow in value or generate long-term income. Examples include student loans, mortgages, and business loans. These debts can improve your financial situation by increasing your earning potential or adding to your assets. Bad debt, on the other hand, involves borrowing for items that do not increase in value or generate income. High-interest credit card debt, payday loans, and financing for luxury items fall into this category. This type of debt can quickly become a financial drain, making it harder to achieve your financial goals. Practical tip: focus on using debt to invest in assets that will appreciate or generate income and avoid taking on high-interest debt for non-essential purchases. How can you create a debt repayment plan? A structured debt repayment plan can help you regain control and reduce financial stress. Here are steps to create an effective strategy. List your debts. Write down all your debts, including the balance, interest rate, and minimum monthly payment for each. Prioritize debts. Focus on paying off high-interest debts first, as they cost you the most interest charges. Alternatively, you can use the debt snowball method to pay off the smallest debts to build momentum. Data budget. Allocate a specific amount each month towards debt repayment. Ensure your budget accounts for all necessary expenses while maximizing debt payments. Make extra payments. Make extra payments on your debts whenever possible to reduce the principal faster. This approach lowers the overall interest you'll pay over time. Practical tip: use online debt repayment calculators to estimate how long it will take to pay off your debts and how much interest you will save by making extra payments. How does the debt snowball method work? The debt snowball method involves paying off your smallest debts first, while making minimum payments on more significant debts. Once a small debt is paid off, you apply that payment amount to the next smallest debt, creating a snowball effect. This method builds motivation and momentum as you see debts eliminated individually. The psychological boost of paying off smaller debts can keep you motivated and committed to your debt repayment plan. How can consolidating debt simplify repayment? Debt consolidation involves combining multiple debts into a loan with a lower interest rate. This strategy can simplify repayment by reducing the monthly payments you need to make and potentially lowering your overall interest costs. Options for consolidating debt include personal loans. Use a personal loan to pay off multiple high-interest debts. Balance transfer credit cards. Transfer high-interest credit card balances to a card with a lower interest rate. Home equity loans or lines of credit allow you to use the equity in your home to consolidate debt, often at a lower interest rate. Practical tip: before consolidating debt, compare the interest rates and fees to ensure it will save you money in the long run. How does reducing debt improve your financial situation? Reducing debt frees up money that can be redirected towards savings and investments. It reduces stress and improves your financial flexibility, allowing you to make more proactive financial decisions. Lower debt levels also improve your credit score, making it easier to access credit at favorable terms in the future. Every payment you make toward reducing your debt brings you closer to financial freedom. Celebrate each milestone and stay focused on your long-term goals. Practical exercise: assess your debt situation. Evaluate your current debt situation by answering the following questions. How much total debt do you have? What are the interest rates on your debts? What is the minimum payment required for each debt? How much can you realistically allocate to debt repayment each month? Use this assessment to create a realistic and actionable debt repayment plan. How can managing debt contribute to a wealth wisdom mindset? Managing debt effectively is a critical component of a wealth wisdom mindset. It involves making informed decisions, being disciplined, and staying committed to your financial goals. By taking control of your debt, you empower yourself to build a more robust economic foundation and achieve long-term success. Embrace debt management as a crucial step toward financial independence. You can overcome debt and create a secure financial future with determination and the right strategies. Practical exercise: create a debt repayment plan. List all debts. Include the balance, interest rate, and minimum payment for each. Choose a repayment strategy. Decide whether to focus on high-interest debts first or use the debt snowball method. Set monthly payments. Allocate a specific amount towards debt repayment in your budget. Make extra payments. Whenever possible, make additional payments to reduce the principal faster. Monitor progress. Regularly review your progress and adjust your plan to stay on track. Managing debt is a vital step in regaining control of your financial life. By differentiating between good and bad debt, creating a structured repayment plan, and exploring consolidation options, you can reduce your debt burden and move toward financial independence. Remember, managing debt is about paying off balances, making informed decisions, and building a solid financial foundation. Every step toward managing and reducing your debt is a step toward financial freedom. Stay committed, be disciplined, and believe in your ability to achieve your financial goals. In the next chapter, we'll explore building credit, your financial reputation. You'll learn how to establish and maintain a good credit score, the impact of credit on your financial life, and strategies to improve your creditworthiness. Chapter 6: Building Credit, Your Financial Reputation. Why is your credit score a crucial aspect of your financial health? Your credit score is a numerical representation of your creditworthiness. It affects your ability to get loans, rent apartments, and secure specific jobs. A good credit score can save money through lower interest rates and better loan terms. Conversely, a poor credit score can limit your financial opportunities and increase your borrowing costs. How is your credit score calculated? Credit scores are typically calculated based on 5 key factors. Payment history 35%. Your record of on-time payments, late payments, defaults, and bankruptcies negatively impact your score. Amounts owed 30%. The total amount of debt you owe compared to your available credit. High credit card balances can lower your score. Length of credit history 15%. The length of time your credit accounts have been active. A more extended history generally improves your score. Credit mix 10%. You have various credit types, such as credit cards, mortgages, and installment loans. A diverse mix can positively affect your score. New credit 10%. The number of recently opened credit accounts and inquiries. Opening multiple new accounts in a short period can lower your score. Practical tip. Regularly check your credit report to ensure accuracy and dispute any errors. You are entitled to a free credit report annually from each of the 3 major credit bureaus: Equifax, Experian, and TransUnion. How can you build and maintain a good credit score? Building and maintaining a good credit score requires consistent, responsible financial behavior. Here are some key strategies. Pay your bills on time. Timely payments are the most significant factor in your credit score. Set up automatic payments or reminders to ensure you never miss a due date. Keep credit card balances low. Aim to use less than 30% of your available credit limit. High balances relative to your credit limit can negatively impact your score. Maintain long-term accounts. Keep older accounts open and active, as a more extended credit history improves your score. Limit new credit applications. Each new credit application results in a hard inquiry on your report, which can lower your score temporarily. Only apply for credit when necessary. Monitor your credit report. Regularly review your credit report to track your progress and identify any discrepancies. Building good credit takes time, but each responsible action contributes to a more robust financial reputation. Stay patient and consistent. How does a good credit score open up new opportunities? A higher credit score can lead to better financial opportunities, such as lower interest rates on loans and credit cards, higher credit limits, and more favorable insurance premiums. It also provides a safety net during financial emergencies, as you are more likely to be approved for credit when needed. Think of your credit score as your financial reputation. Just as you work to build a good personal reputation, maintaining a good credit score opens doors to economic opportunities and security. Practical exercise. Assess your credit health. Evaluate your current credit situation by answering the following questions. Do you pay your bills on time each month? What is your current credit utilization ratio? How long have your credit accounts been active? Do you have a diverse mix of credit types? How many new credit accounts have you opened recently? Use this assessment to identify areas for improvement and develop a plan to enhance your credit score. Practical tip. Use credit monitoring services to monitor your score and receive alerts about significant changes or potential fraud. How can improving your credit score impact your financial future? Improving your credit score can significantly enhance your financial stability and flexibility. With a higher score, you can access credit more efficiently and at better terms, saving you money over time. A good credit score can also positively impact other areas of your life, such as securing rental agreements or employment opportunities. Every positive action you take toward improving your credit score is an investment in your financial future. Stay committed, and the benefits will follow. How does understanding credit reports contribute to financial literacy? A credit report provides a detailed history of your credit activities, including loans, credit cards, and payment history. Understanding your credit report helps you manage your credit effectively and identify any errors or fraudulent activities that could impact your score. Practical tip. Regularly request and review your credit reports from all 3 major credit bureaus. Address discrepancies immediately to ensure your credit report accurately reflects your financial behavior. Practical exercise. Improve your credit score. Review your credit report. Obtain your free credit report from Equifax, Experian, and TransUnion. Carefully review each report for errors or discrepancies. Pay down balances. Focus on paying down high-interest credit card balances to lower your credit utilization ratio. Set up payment reminders. Use calendar alerts or automatic payments to ensure all bills are paid on time. Limit new credit applications. Avoid applying for new credit to prevent hard inquiries on your report. Diversify your credit mix. If possible, add different types of credit, such as a small personal loan, to your credit profile. Building and maintaining a good credit score is crucial for financial health and opportunities. Understanding how your credit score is calculated, adopting responsible credit behaviors, and regularly monitoring your credit report can enhance your financial reputation and access better economic opportunities. Remember, improving your credit score is a journey that requires patience and consistency. Your credit score is within your control. Dedication and the right strategies can build a solid financial foundation and open doors to a brighter economic future. The next chapter will explore financial planning, mapping out your future. You'll learn how to set realistic financial goals, create a comprehensive financial plan, and adjust it as needed to stay on track and achieve your long-term aspirations. Chapter 7. Financial Planning, Mapping Out Your Future. How can a financial plan transform your goals into reality? A financial plan acts as a roadmap for your financial journey. It helps you set realistic goals, track progress, and adjust as needed. Without a plan, it's easy to get lost or make impulsive decisions that derail your financial progress. Financial planning is not just about wealth accumulation, it's about achieving peace of mind and ensuring a secure future for yourself and your loved ones. Why is setting financial goals crucial? Setting financial goals gives you a clear direction and purpose. It helps you prioritize your spending and saving efforts, ensuring your money achieves your most important objectives. Financial goals can be short-term, like saving for a vacation, or long-term, like planning for retirement. Start by defining your financial goals clearly. Use the SMART criteria to make your goals specific, measurable, achievable, relevant, and time-bound. For example, instead of saying "I want to save money," set a goal like "I want to save $5,000 for a down payment on a house within 2 years. Practical tip: write down your goals and review them regularly. This practice keeps you focused and motivated to achieve them. How do you create a comprehensive financial plan? A comprehensive financial plan involves several key components. Budgeting. Outline your income and expenses to ensure you live within your means and allocate funds toward your goals. Saving. Set aside money for short-term and long-term goals, including an emergency fund. Investing. Grow your wealth by investing in a diversified portfolio. Debt management. Develop a strategy to pay off high-interest debt and use debt wisely. Insurance. Protect yourself and your assets with appropriate insurance coverage. Retirement planning. Plan for a financially secure retirement by estimating your future needs and saving accordingly. Estate planning. Ensure your assets are distributed according to your wishes and your loved ones are provided for. Practical tip: use financial planning software or consult a financial advisor to create a detailed plan tailored to your situation. How does regular review and adjustment of your financial plan ensure success? Life is full of changes, and your financial plan should be flexible enough to adapt. Regularly reviewing and adjusting your plan ensures that you stay on track and can respond to new opportunities or challenges. Set aside time each year to review your plan, assess your progress, and make necessary adjustments. Your financial plan is a living document. Don't be afraid to make changes as your circumstances and goals evolve. The key is to stay committed and keep moving forward. How can tracking your progress keep you motivated? Tracking your progress toward your financial goals helps you stay motivated and focused. It allows you to celebrate small victories and identify areas for improvement. Use spreadsheets, apps, or financial journals to monitor your progress. No matter how small, every step you take brings you closer to your financial goals. Celebrate your achievements and use them as motivation to keep going. Chapter 8. Emergency funds, your financial safety net. Why is having an emergency fund essential for financial stability? Life is unpredictable, and unexpected expenses can arise at any time. Whether it's a medical emergency, car repairs, or sudden job loss, having an emergency fund provides a financial safety net to handle these unforeseen events without falling into debt. An emergency fund gives you peace of mind, knowing you are prepared for life's uncertainties. How much should you save in your emergency fund? A common rule of thumb is to save 3 to 6 months of living expenses in your emergency fund. This amount provides a comfortable cushion to cover your essential expenses if you face a financial setback. The exact amount may vary based on your circumstances, such as job stability, health, and family size. Practical tip. As an initial goal, aim to save at least $1,000. Once you reach this milestone, gradually build up to the 3 to 6 month target. Where should you keep your emergency fund? Your emergency fund should be easily accessible if you need it quickly. Consider keeping it in a high-yield savings account that offers easy access while earning interest. Avoid investing your emergency fund in stocks or other volatile assets, as you need this money to be available when emergencies arise without the risk of losing value. Practical tip. Research different high-yield savings accounts to find one that offers a reasonable interest rate and easy access to your funds. How can you consistently build your emergency fund? Building an emergency fund requires discipline and consistency. Here are some strategies to help you save. Set a savings goal. Determine how much you need to save and set a timeline for reaching your goal. Automate savings. Set up automatic monthly transfers from your checking account to your emergency fund. This method ensures you save regularly without having to think about it. Cut unnecessary expenses. Review your budget and identify areas for reduction. Redirect these savings into your emergency fund. Use windfalls wisely. Allocate a portion of any unexpected income, such as tax refunds, bonuses, or gifts, to your emergency fund. Every dollar you save brings you closer to financial security. Stay consistent and celebrate your progress along the way. What should you consider when using your emergency fund? Your emergency fund is meant for genuine emergencies, not for discretionary spending. Use it only for unexpected expenses that are essential and unavoidable. When you need to use your emergency fund, make it a priority to replenish it as soon as possible. Practical tip. Define what constitutes an emergency for you and your family. This clarity helps avoid unnecessary withdrawals and ensures funds are available when needed. How does having an emergency fund impact your financial stability? An emergency fund enhances financial stability by reducing the need to rely on credit cards or loans during emergencies. It helps you avoid high-interest debt and maintain your financial health. Additionally, knowing you have a safety net allows you to focus on other financial goals confidently. Think of your emergency fund as your financial armor. It protects you from unexpected blows and keeps you firm in facing challenges. Practical exercise. Start building your emergency fund. Follow these steps to kickstart your emergency fund. Set a goal. Determine your initial savings target and your ultimate goal. Create a plan. Outline how much you must save each month to reach your goal within your desired time frame. Automate savings. Set up automatic transfers to your emergency fund account. Monitor progress. Regularly review your progress and adjust your plan as needed. Practical tip. If your income is irregular, save a percentage of each paycheck rather than a fixed amount. This approach ensures you save consistently, regardless of your earnings. How does an emergency fund provide peace of mind? Knowing you have an emergency fund in place reduces financial stress and anxiety. It gives you the confidence to handle unexpected expenses without derailing your financial plans. This peace of mind lets you focus on long-term goals and enjoy life without worrying about financial setbacks. Building an emergency fund is an investment in your peace of mind. Stay dedicated to your savings plan, and you'll enjoy its security. How does an emergency fund align with a wealth wisdom mindset? An emergency fund is a critical component of a wealth wisdom mindset. It reflects prudent financial planning, discipline, and a proactive approach to managing money. You are committed to economic stability and resilience by prioritizing an emergency fund. View your emergency fund as a foundation of your financial house. A strong foundation supports everything, allowing you to build wealth and confidently achieve your goals. Practical exercise. Evaluate your emergency fund. Assess your current emergency fund status by answering the following questions. How much have you saved in your emergency fund? How many months of living expenses does this cover? What steps can you take to increase your savings? Use this assessment to make necessary adjustments to your savings plan and ensure you are on track to meet your goals. An emergency fund is a crucial element of financial stability and security. By setting clear savings goals, automating your savings, and using your funds wisely, you can protect yourself from financial setbacks and focus on achieving your long-term objectives. Remember, building an emergency fund requires discipline and consistency, but the peace of mind it provides is well worth the effort. Your financial security is within your control. Start building your emergency fund today, and take comfort in knowing you are prepared for whatever life may bring. In the next chapter, we'll explore retirement planning, securing your future. You'll learn how to estimate your retirement needs, choose the proper retirement accounts, and develop a saving strategy to ensure a comfortable and financially secure retirement. Chapter 9. Retirement Planning, Securing Your Future. How early should you start planning for retirement? The sooner you start planning for retirement, the better. Time is a powerful ally in building a substantial retirement fund through compound interest. Starting early allows your investments more time to grow, significantly enhancing your financial security in retirement. Why is estimating your retirement needs crucial? Estimating your retirement needs helps you set realistic savings goals and plan effectively. Consider your desired retirement lifestyle, expected living expenses, healthcare costs, and any other financial commitments you may have. A general rule of thumb is to aim for 70 to 80% of your pre-retirement income to maintain your standard of living. Practical tip: use online retirement calculators to estimate how much you need to save based on your current age, income, and desired retirement age. What types of retirement accounts should you consider? Various retirement accounts offer tax advantages and other benefits. Understanding these options helps you choose the best vehicles for your retirement savings. 401k or 403b plans. Employer-sponsored plans that allow you to contribute pre-tax dollars, often with an employer match. This match is essentially free money, so aim to contribute enough to get the full match. Individual retirement accounts (IRAs). Traditional IRAs allow pre-tax contributions, while Roth IRAs use after-tax contributions but offer tax-free withdrawals in retirement. Health savings accounts (HSAs). If you have a high-deductible health plan, HS offer triple tax benefits: tax-deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. Practical tip: maximize contributions to retirement accounts with tax advantages. Prioritize accounts based on their benefits and your financial situation. How does diversification protect your retirement savings? Diversification involves spreading your investments across various asset classes, such as stocks, bonds, and real estate, to reduce risk. A diversified portfolio protects you from market volatility, ensuring that poor performance in one area does not drastically affect your overall savings. Practical tip: to quickly achieve diversification, use target date funds or balanced mutual funds. These funds automatically adjust the asset allocation as you approach retirement. Why is regular review and adjustment of your retirement plan critical? Life changes, and so do your financial circumstances and retirement goals. Regularly reviewing and adjusting your retirement plan ensures it aligns with your current situation and aspirations. This practice helps you stay on track and adjust your savings rate, investment strategy, or retirement goals. Your retirement plan is a living document. Stay flexible and be willing to adjust it as needed to ensure it meets your evolving needs. Practical exercise: create your retirement plan. Follow these steps to create a robust retirement plan. Set retirement goals. Define your desired retirement age, lifestyle, and financial needs. Estimate savings needs. Use retirement calculators to determine how much you need to save. Choose retirement accounts. Select the best retirement accounts based on your situation. Diversify investments. Build a diversified portfolio that balances risk and growth potential. Automate contributions. Set up automatic contributions to your retirement accounts. Review regularly. Regularly review and adjust your plan to stay on track. Practical tip: consider consulting a financial advisor to help you create and maintain a personalized retirement plan. How does compounding interest enhance your retirement savings? Compound interest allows your investments to grow exponentially over time. The interest you earn on your initial investment begins to earn interest itself, creating a snowball effect. The earlier you start saving, the more time your money has to compound, significantly increasing your retirement fund. Consider compounding interest as a valuable tool in your financial arsenal. The longer you dedicate to building it up, the greater the rewards you'll reap from compounding. How can tax strategies optimize your retirement savings? Understanding tax implications helps you optimize your retirement savings. Different retirement accounts offer various tax benefits, and knowing how to leverage these can maximize your savings. For example, Roth IRAs offer tax-free withdrawals in retirement, which can be advantageous if you expect to be in a higher tax bracket. Contributing to traditional and Roth retirement accounts can diversify your tax strategies, providing flexibility and potential tax benefits in retirement. How does planning for healthcare costs protect your retirement savings? Healthcare costs are a significant expense in retirement. Planning for these costs ensures you are prepared and not deplete your savings unexpectedly. Consider long-term care insurance, Medicare, and HSAs as part of your healthcare planning strategy. Factor in healthcare costs when estimating your retirement needs. Consider HSAs for tax-advantaged healthcare savings. Review your retirement progress. Assess your current retirement planning status by answering the following questions. How much have you saved for retirement so far? Are you maximizing contributions to tax-advantaged retirement accounts? Is your investment portfolio diversified? Have you estimated your retirement needs accurately? Are you prepared for healthcare costs in retirement? Use this assessment to make necessary adjustments to your retirement plan and ensure you are on track to meet your goals. Planning for retirement is crucial for securing your financial future and ensuring a comfortable and fulfilling life after work. You can build a substantial retirement fund by starting early, setting clear goals, choosing the proper retirement accounts, and regularly reviewing your plan. Remember, retirement planning is an ongoing process that requires dedication, flexibility, and informed decision-making. Your retirement journey starts today. Take proactive steps to plan and save, and you'll be well on your way to a secure and enjoyable retirement. In the next chapter, we'll explore the importance of insurance in protecting your assets. You'll learn about different types of insurance, how to choose the right coverage, and strategies to protect you and your loved ones against life's uncertainties. Chapter 10. Insurance protecting your assets. What role does insurance play in your financial plan? Insurance is a critical component of a comprehensive financial plan. It protects you and your assets from significant economic losses due to unexpected events like accidents, illness, or natural disasters. An unforeseen event could derail your financial progress without adequate insurance and burden you with substantial costs. Why is it essential to understand different types of insurance? Understanding the various types of insurance helps you choose the right coverage for your needs. Different insurance policies protect other aspects of your life and assets. Here are the main types of insurance to consider. Health insurance. It covers medical expenses, including doctor visits, hospital stays, and prescription medications. It is crucial to protect your finances against high healthcare costs. Life insurance provides financial support to your beneficiaries in the event of your death. It can help cover funeral expenses, pay off debts, and provide income replacement. Auto insurance protects you against financial loss in car accidents, theft, or damage. It typically includes liability coverage, collision coverage, and comprehensive coverage. Homeowners or renters insurance covers damage to your home or personal belongings due to fire, theft, or natural disasters. Homeowners insurance also includes liability coverage for accidents that occur on your property. Disability insurance provides income replacement if you cannot work due to injury or illness. It ensures you can cover living expenses while you recover. Long-term care insurance covers the costs of long-term care services, such as nursing homes or in-home care, which are not typically covered by health insurance or Medicare. Umbrella insurance offers additional liability coverage beyond what is provided by your auto and homeowners insurance policies. It protects you against large claims and lawsuits. Practical tip: regularly review your insurance policies to ensure they meet your current needs and provide adequate coverage. How can you determine the right amount of insurance coverage? Determining the right amount of insurance coverage involves assessing your financial situation, risks, and needs. Here are some steps to help you decide. Evaluate your assets. Consider the value of your assets, including your home, car, savings, and investments. Ensure your insurance coverage can adequately protect these assets. Assess your risks. Identify potential risks, such as health issues, accidents, or natural disasters, and evaluate their likelihood of occurring. Consider your dependents. If you have dependents, such as children or a spouse. Ensure you have sufficient life and disability insurance to provide for them in case of your death or disability. Review policy limits. Check the limits of your existing policies and determine if they are sufficient. Adjust your coverage as needed to match your current situation. Practical tip. Consult with an insurance advisor for personalized recommendations based on your circumstances. How does having adequate insurance coverage provide peace of mind? Adequate insurance coverage provides peace of mind by reducing financial stress and uncertainty. Knowing that you are protected against significant financial losses allows you to focus on other aspects of your life and financial planning without constant worry about potential disasters. Think of insurance as a safety net. It protects you when life throws unexpected challenges, allowing you to recover and move forward confidently. What should you consider when choosing an insurance provider? Choosing the right insurance provider is as important as selecting the proper coverage. Here are some factors to consider. Reputation. Research the provider's reputation and customer reviews to ensure they are reliable and trustworthy. Financial stability. Choose a provider with strong financial ratings to ensure they can pay out claims when needed. Customer service. Look for a provider with excellent customer service so you can quickly get assistance and resolve any issues. Coverage options. Ensure the provider offers the types of coverage you need and allows customization to fit your specific requirements. Cost. Compare premiums, deductibles, and coverage limits from different providers to find the best value for your money. Practical tip. Use online comparison tools to evaluate different insurance providers and policies. Practical exercise. Review your insurance coverage. Take the following steps to review and optimize your insurance coverage. List your policies. Write down all your current insurance policies, including coverage amounts, premiums, and deductibles. Evaluate coverage. Assess if each policy provides adequate coverage for your current needs and risks. Identify gaps. Identify gaps in your coverage and determine which additional policies or adjustments are necessary. Get quotes. Obtain quotes from multiple insurance providers to compare costs and coverage options. Update policies. Make changes to your policies or purchase additional coverage to ensure comprehensive protection. Practical tip. Schedule an annual insurance review to keep your coverage up to date with your changing needs and circumstances. How does insurance align with a wealth wisdom mindset? Insurance is a critical component of a wealth wisdom mindset. It reflects prudent financial planning, risk management, and a proactive approach to protecting assets and loved ones. Ensuring adequate insurance coverage demonstrates a commitment to long-term economic stability and resilience. View insurance as an investment in your financial security. Its protection allows you to pursue your financial goals with greater confidence and peace of mind. Practical exercise. Conduct an insurance needs assessment. Evaluate your insurance needs by answering the following questions. Do you have sufficient health insurance to cover medical expenses? Is your life insurance coverage adequate to provide for your dependents? Do you have comprehensive auto and homeowners or renters insurance? Are you protected against income loss with disability insurance? Have you considered long-term care insurance for future needs? Do you have umbrella insurance for additional liability protection? Use this assessment to identify areas where you need to adjust your coverage or add new policies. Insurance is vital to your financial plan, protecting against significant economic losses and ensuring long-term stability. By understanding different types of insurance, determining the right coverage, and choosing a reliable provider, you can safeguard your assets and loved ones against life's uncertainties. Remember, adequate insurance coverage offers peace of mind and lets you focus on achieving your financial goals. Take proactive steps to review and optimize your insurance coverage today. Your future self will thank you for the protection and security it provides. In the next chapter, we'll explore estate planning, preparing for the future. You'll learn how to create a will, set up trusts, and ensure your assets are distributed according to your wishes, providing for your loved ones and securing your legacy. Chapter 11. Estate Planning, Preparing for the Future. Why is estate planning an essential part of financial management? Estate planning involves preparing to manage and distribute your assets after your death. It ensures that your wishes are honored, your loved ones are provided for, and your estate is handled efficiently and with minimal tax burden. Without an estate plan, the state decides how to distribute your assets, which may not align with your desires and could lead to complications for your heirs. How can you begin the estate planning process? Starting the estate planning process involves several key steps. First, inventory your assets including property, investments, savings, and personal belongings. Next, consider how you want these assets distributed and who should manage your estate. Practical tip: consult an estate planning attorney to ensure your plan complies with state laws and addresses all necessary components. What are the critical components of an estate plan? An effective estate plan typically includes the following components: will, a legal document that outlines how your assets will be distributed after your death. It also allows you to name guardians for minor children. Trusts, legal entities that hold assets on behalf of beneficiaries. Trusts can help manage and protect your assets, reduce estate taxes, and avoid probate. Power of attorney, a document that designates someone to make financial and legal decisions on your behalf if you become incapacitated. Healthcare proxy, if you cannot, a document designates someone to make healthcare decisions on your behalf. Beneficiary designations, forms that specify who will receive assets from accounts such as life insurance policies, retirement accounts, and bank accounts. A letter of intent, a non-legally binding document that provides additional instructions and wishes regarding your estate and personal matters. Estate tax planning, strategies to minimize the taxes that may be due on your estate, ensuring more of your assets go to your heirs. Practical tip: regularly review and update your estate plan to reflect changes in your assets, family situation, and laws. How can creating a will benefit your loved ones? A will ensures your assets are distributed according to your wishes and can prevent family disputes. It provides clear instructions on how your estate should be handled, reducing the burden on your loved ones during a difficult time. Additionally, a will allows you to name an executor to manage your estate and fulfill your wishes. Creating a will is an act of love and responsibility. It ensures your loved ones are cared for and your legacy is preserved. What are the benefits of setting up trusts? Trusts offer several benefits, including avoiding probate. Trusts can help your estate bypass the probate process, saving time and reducing legal fees. They are protecting assets. Trusts can protect your assets from creditors and lawsuits. Tax benefits. Certain types of trusts can reduce estate and gift taxes. Managing assets. Trusts allow you to specify how and when your assets will be distributed to beneficiaries, providing more control over your estate. Practical tip: work with an estate planning attorney to determine which types of trusts best suit your needs and goals. How does a power of attorney safeguard your interests? A power of attorney ensures that someone you trust can make financial and legal decisions on your behalf if you become incapacitated. This designation prevents the court from appointing a guardian, which may not align with your wishes and could lead to delays and complications. Practical tip: choose a power of attorney who understands your values and will act in your best interests. Discuss your wishes with them in advance. How can a healthcare proxy provide peace of mind? A healthcare proxy allows you to designate someone to make medical decisions on your behalf if you cannot. This person, a healthcare agent or surrogate, can ensure your healthcare preferences are honored, providing peace of mind for you and your loved ones. Practical tip: discuss your healthcare preferences with your designated proxy and provide them with a copy of your healthcare directive or living will. Practical exercise: start your estate planning. Follow these steps to begin your estate planning process. Take inventory. List all your assets, including property, investments, savings, and personal belongings. Set goals. Determine how your assets are distributed and who should manage your estate. Consult an attorney. Work with an estate planning attorney to create a will, set up trusts, and complete other necessary documents. Designate representatives. Choose a power of attorney and healthcare proxy to act on your behalf if needed. Review and update. Regularly review your estate plan to ensure it reflects your current wishes and circumstances. Practical tip: keep your estate planning documents in a safe, accessible place and inform your executor and loved ones of their location. How does estate planning contribute to a wealth wisdom mindset? Estate planning reflects a proactive and thoughtful approach to managing wealth and protecting the legacy. It demonstrates a commitment to ensuring your loved ones are provided for and your wishes are honored. Planning reduces the burden on your family and creates a lasting impact. View estate planning as a gift to your loved ones. It provides clarity and direction, allowing them to focus on healing and remembering you rather than dealing with legal and financial complications. Practical exercise. Assess your estate planning needs. Evaluate your current estate planning status by answering the following questions. Do you have a will that clearly outlines your wishes? Have you set up trusts to manage and protect your assets? Do you have a designated power of attorney and healthcare proxy? Are your beneficiary designations up to date? Have you discussed your estate plan with your loved ones and representatives? Use this assessment to identify areas where you may need to create or update documents and make necessary changes. Estate planning is a vital part of financial management that ensures your assets are distributed according to your wishes and your loved ones are provided for. Creating a comprehensive estate plan, including a will, trusts, power of attorney, and healthcare proxy, protects your legacy and provides peace of mind for yourself and your family. Remember, estate planning is an ongoing process that requires regular review and updates. Take the time to plan your estate today. Your foresight and care will leave a lasting legacy and provide invaluable support to your loved ones. In the next chapter, we'll explore teaching financial literacy, empowering the next generation. You'll learn how to educate your children and others about money management, instilling financial wisdom to benefit them for a lifetime. Chapter 12. Teaching financial literacy, empowering the next generation. How can teaching financial literacy to others create a lasting impact? By teaching financial literacy to others, you empower them to make informed financial decisions and achieve financial independence. Sharing your knowledge creates a ripple effect, improving the economic well-being of families and communities. Educating the next generation about money management is particularly impactful, as it sets the foundation for lifelong financial habits and decision-making. Why is it essential to start financial education early? Starting financial education early instills good money habits that can last a lifetime. Children and teenagers who learn about budgeting, saving, and investing are better equipped to handle financial challenges and opportunities as they grow older. Early financial education also helps young people develop a healthy relationship with money, reducing the likelihood of debt and economic stress. Practical tip. Begin teaching financial concepts to children at a young age, using age-appropriate methods and examples. What are effective ways to teach financial literacy to children? Teaching financial literacy to children can be both fun and educational. Here are some effective methods. Involve children in everyday financial decisions, such as grocery shopping or budgeting for a family outing. Explain the costs and benefits of different choices. Give allowance and savings goals. Provide a weekly allowance and encourage children to save a portion of it. Set specific savings goals, such as buying a toy or a game, to teach the value of delayed gratification. Play educational games. Use board games or online games that teach financial concepts, such as Monopoly or financial literacy apps. Open a savings account. Help children open their first savings account and teach them how to track their balance and interest earned. Discuss needs versus wants. Teach children the difference between needs and wants, helping them prioritize spending. Practical tip. Reinforce financial lessons with consistent practice and positive reinforcement. Celebrate their savings milestones and smart financial choices. How can teenagers and young adults benefit from financial education? Teenagers and young adults face significant financial decisions, such as paying for college, getting their first job, and managing their own money. Financial education helps them navigate these challenges confidently and responsibly. Key topics include budgeting, credit, debt management, and investing. Practical tip. Encourage teenagers to take financial literacy courses offered by schools, community organizations, or online platforms. What are some effective strategies for teaching teenagers and young adults financial literacy? Here are some strategies to effectively teach financial literacy to teenagers and young adults. Budgeting. Teach them how to create and manage a budget, emphasizing the importance of tracking income and expenses. Credit and loans. Explain how credit works, the importance of maintaining a good credit score, and the risks of high interest debt. Discuss student loans and how to manage them responsibly. Investing. Introduce the basics of investing, including stocks, bonds, and mutual funds. Please encourage them to start investing early to benefit from compound interest. Workshops and seminars. Encourage participation in financial literacy workshops and seminars to gain practical knowledge and skills. Simulations. Use real-life simulations like mock investment portfolios or budget challenges to provide hands-on learning experiences. Practical tip. Provide access to financial tools and resources, such as budgeting apps and investment platforms, to help teenagers and young adults manage their finances effectively. How can open discussions about money within the family foster financial literacy? Encouraging open discussions about money within the family helps demystify financial concepts and reduces the stigma around financial topics. It creates a supportive environment where family members can share their experiences, ask questions, and learn from each other. Be transparent about your financial decisions and involve your children in age-appropriate conversations about budgeting, saving, and investing. What role do schools and communities play in financial education? Schools and communities play a crucial role in providing financial education. Integrating financial literacy into school curriculums ensures all students receive essential financial knowledge. Community organizations can offer workshops, seminars, and resources to enhance financial literacy for all age groups. Practical tip. Advocate for school financial literacy programs and support community initiatives promoting economic education. Practical exercise. Develop a financial literacy plan for your family. Create a financial literacy plan tailored to your family's needs and goals. Set financial goals. Identify specific financial goals for each family member, such as saving for a vacation or a college fund. Choose teaching methods. Select appropriate teaching methods and resources for each age group. Schedule regular discussions. Set aside time for family discussions about money, budgeting, and financial goals. Track progress. Monitor each family member's progress toward their financial goals and provide guidance and support as needed. Practical tip. Use visual aids, such as charts or goal trackers, to make financial education engaging and interactive for children. How can fostering financial literacy benefit society? Fostering financial literacy leads to a more financially stable and resilient society. It reduces poverty, improves economic opportunities, and enhances overall quality of life. Economically literate individuals are better equipped to make informed decisions, manage debt, and build wealth, contributing to a healthier economy. Think of financial literacy as a seed. Planting it in others grows into a forest of financially savvy individuals, contributing to a stronger, healthier community. Practical exercise. Assess your family's financial literacy. Evaluate your family's current level of financial literacy by answering the following questions. Do family members understand basic financial concepts, such as budgeting, saving, and investing? Are children and teenagers involved in financial discussions and decision-making? Do family members have specific financial goals and a plan to achieve them? Are financial literacy resources, such as books, apps, and courses, available to the family? Use this assessment to identify areas for improvement and develop a plan to enhance your family's financial literacy. Teaching financial literacy to the next generation is a powerful way to empower them with the knowledge and skills they need to achieve economic independence. Starting financial education early, using effective teaching methods, and fostering open discussions about money within the family can instill lifelong financial habits and decision-making skills. Remember, financial literacy benefits not only individuals and families but also society. Invest in your children's and loved ones' financial education today. The knowledge and skills they gain will serve them well throughout their lives, enabling them to achieve their goals and contribute to a more financially secure society. The next chapter will explore continuous learning, staying informed, and adapting. You'll learn the importance of ongoing financial education, how to stay updated on economic trends, and strategies for adapting your financial plan to changing circumstances. Chapter 13. Continuous learning, staying informed, and adapting. Why is continuous learning crucial in personal finance? The financial landscape constantly evolves, with new products, strategies, and regulations emerging regularly. Staying informed and learning about personal finance ensures you can adapt to these changes and make the best decisions for your financial future. Ongoing financial education helps you stay ahead of the curve, avoid common pitfalls, and seize new opportunities. How can you stay updated on financial trends and developments? Staying updated on financial trends and developments requires a proactive approach. Here are some effective strategies. Read financial news. Regularly read reputable financial news sources, such as the Wall Street Journal, Bloomberg, and economics sections of major newspapers. Follow financial experts, advisors, and thought leaders on social media and subscribe to their newsletters for insights and updates. Listen to financial podcasts. Tune into financial podcasts that discuss current trends, investment strategies, and personal finance tips. Attend workshops and seminars. Learn from industry professionals through financial workshops, webinars, and seminars. Take online courses. Enroll in online courses that cover various aspects of personal finance, from basic budgeting to advanced investing. Practical tip. Set aside weekly time to read, listen to, or watch financial content to stay informed and updated. How does continuous learning enhance your financial decision-making? Continuous learning enhances your financial decision-making by equipping you with the knowledge and skills needed to navigate the complexities of the financial world. It helps you understand new financial products, comply with regulations, and make informed investment choices. With up-to-date knowledge, you can confidently adjust your financial plan to align with changing circumstances and goals. Embrace a mindset of lifelong learning. Each new piece of knowledge you gain strengthens your ability to manage your finances effectively. What are some resources for ongoing financial education? Numerous resources are available for ongoing financial education. Here are some recommended options. Books. Read books on personal finance, investing, and wealth management. Some classics include Rich Dad, Poor Dad by Robert Kiyosaki, The Total Money Makeover by Dave Ramsey, and The Intelligent Investor by Benjamin Graham. Websites and blogs. Follow reputable financial websites and blogs like Investopedia, NerdWallet, and The Simple Dollar. Online courses and webinars. Platforms like Coursera, Udemy, and Khan Academy offer personal finance and investing courses. Professional organizations. Join professional organizations, such as the Financial Planning Association (FPA) or the National Association of Personal Financial Advisors (NAFA), for access to resources and networking opportunities. Practical tip. Create a curated list of financial education resources that you can refer to regularly for continuous learning. How can staying informed help you adapt your financial plan? Staying informed helps you adapt your financial plan by providing the information needed to make timely adjustments. Whether it's responding to changes in tax laws, adjusting your investment strategy due to market trends, or revising your budget based on economic conditions, being informed allows you to stay agile and proactive. Motivational insight. Think of your financial plan as a living document. It evolves as you grow and adapt to new information, ensuring that you remain on the path to achieving your goals. Practical exercise. Create a financial learning plan. Develop a financial learning plan to ensure you stay informed and continue growing your financial knowledge. Set learning goals. Identify areas of personal finance you want to learn more about, such as investing, tax planning, or retirement strategies. Choose resources. Select a mix of books, websites, courses, and experts to follow for ongoing education. Schedule learning time. Allocate regular weekly time for financial learning and treat it as an essential part of your routine. Join discussions. Participate in online forums, social media groups, or local meetups to discuss financial topics and learn from others. Practical tip. Keep a financial journal to track what you learn, note insights, and reflect on how to apply new knowledge to your financial plan. How does adapting to changes in your circumstances impact your financial plan? Life events like marriage, having children, changing jobs, or facing health issues can significantly impact your financial plan. Adapting to these changes ensures that your plan remains relevant and practical. Regularly review and update your financial plan to account for income, expenses, goals, and priorities changes. Embrace change as an opportunity to refine and improve your financial plan. Flexibility and adaptability are critical to long-term economic success. Practical exercise. Review and update your financial plan. Conduct a thorough review of your financial plan to ensure it aligns with your current circumstances and goals. Assess your current situation. Review your income, expenses, savings, investments, and debts. Evaluate your goals. Ensure your financial goals are still relevant and adjust them if necessary. Analyze your investments. Review your investment portfolio and adjust based on market conditions and risk tolerance. Update your budget. Modify your budget to reflect any changes in income, expenses, or financial priorities. Review insurance coverage. Ensure you have adequate insurance coverage for your current needs. Practical tip. Schedule an annual financial review to keep your plan updated and responsive to changes. How does continuous learning contribute to a wealth wisdom mindset? Continuous learning is a cornerstone of a wealth wisdom mindset. It reflects a commitment to personal growth, financial literacy, and proactive management of one's economic future. By staying informed and adaptable, one demonstrates a dedication to making intelligent, informed decisions that support long-term economic well-being. View each learning opportunity as a step toward greater financial empowerment. The more you know, the better equipped you are to achieve your financial goals. Practical exercise. Evaluate your financial knowledge. Assess your current level of financial knowledge by answering the following questions. Do you regularly read financial news and updates? Are you aware of current trends in the financial markets? Do you understand the basics of investing, tax planning, and retirement strategies? Enhances your financial well-being. Have you taken any financial courses or attended workshops recently? Enhances your financial well-being. Have you taken any financial courses or attended workshops recently? Use this assessment to identify areas for improvement and develop a plan to improve your financial knowledge. Continuous learning is essential for staying informed and adapting to the ever-changing financial landscape. Committing to ongoing financial education empowers you to make informed decisions, adjust your financial plan as needed, and achieve long-term economic success. Remember, a wealth wisdom mindset embraces lifelong learning and adaptability, ensuring you remain proactive and prepared for the future. Invest in your financial education today. The knowledge and skills you gain will serve you well throughout your financial journey, helping you achieve your goals and build a secure, prosperous future. The next chapter will explore embracing a wealth wisdom mindset, the path to financial independence. You'll learn how to cultivate attitudes and behaviors that support financial health and independence, fostering a proactive and disciplined approach to managing your money. Chapter 14. Embracing a wealth wisdom mindset, the path to financial independence. What is a wealth wisdom mindset, and how can it transform your financial life? A wealth wisdom mindset is about adopting attitudes and behaviors that support financial health and independence. It involves being proactive, disciplined, and resilient in managing money. By cultivating this mindset, you can transform your financial life and make informed decisions that align with your long-term goals and values. Why is it important to set clear financial goals? Setting clear financial goals gives you direction and purpose. It helps you prioritize your spending and saving efforts, ensuring your money achieves your most important objectives. Financial goals can be short-term, like saving for a vacation, or long-term, like planning for retirement. Practical tip. Use the SMART criteria to set specific, measurable, achievable, relevant, and time-bound goals. This approach makes your goals more tangible and more accessible to achieve. How does staying committed to your financial plan foster success? Staying committed to your financial plan requires discipline and consistency. Regularly reviewing and adjusting your plan ensures it remains relevant and practical. Sticking to your plan, even when faced with challenges, builds the resilience to achieve long-term success. Persistence is key. Every step you take towards your financial goals, no matter how small, brings you closer to financial independence. What role does mindfulness play in managing your finances? Mindfulness involves being aware of your financial habits and decisions, and their impact on your financial health. By practicing mindfulness, you can make more intentional choices, avoid impulsive spending, and align your financial behaviors with your long-term goals. Practical tip. Keep a financial journal to track your spending, reflect on your financial decisions, and identify areas for improvement. How can gratitude and contentment enhance your financial well-being? Practicing gratitude and contentment helps you appreciate what you have, reducing the urge to overspend or accumulate unnecessary debt. By focusing on your blessings and being content with your current situation, you can make more thoughtful financial decisions that support your long-term goals. Navigate financial uncertainties confidently. Gratitude shifts your focus from what you lack to what you have, fostering a positive and abundant mindset. How does continuous learning support a wealth wisdom mindset? Continuous learning informs you about financial trends, strategies, and best practices. By staying educated, you can adapt to changes in the economic landscape, make informed decisions, and continuously improve your financial literacy. Practical tip: set aside weekly time for financial education, such as reading books, taking courses, or following economic news. How can cultivating patience and resilience contribute to financial independence? Financial independence is a long-term goal that requires patience and resilience. While there will be setbacks and challenges, maintaining a patient and resilient mindset helps you stay focused and committed to your goals. View setbacks as learning opportunities. Each challenge you overcome strengthens your financial resilience and brings you closer to your goals. Practical exercise: develop a wealth wisdom mindset. Set clear goals. Define your short-term and long-term financial goals using the SMART criteria. Create a plan. Develop a detailed financial plan that outlines the steps needed to achieve your goals. Practice mindfulness. Track your spending, reflect on your financial decisions, and make intentional choices. Cultivate gratitude. Focus on your blessings and practice contentment to reduce the urge to overspend. Commit to learning. Stay informed about financial trends and continuously improve your financial literacy. Build resilience. Develop a mindset of patience and resilience to navigate financial challenges. Practical tip: use positive affirmations to reinforce your commitment to a wealth wisdom mindset. Affirmations such as "I am capable of achieving my financial goals" can boost your confidence and motivation. How does a proactive approach to finances lead to financial independence? A proactive approach involves taking control of your financial situation, setting clear goals, and making informed decisions to achieve them. It means anticipating challenges, planning for the future, and regularly reviewing your progress. By being proactive, you can confidently navigate financial uncertainties and stay on track to achieve economic independence. Proactivity empowers you to shape your financial future, rather than simply reacting to circumstances. How can embracing a wealth wisdom mindset improve your overall quality of life? Embracing a wealth wisdom mindset enhances financial well-being and improves overall quality of life. Financial independence allows you to pursue your passions, support your loved ones, and enjoy a fulfilling and stress-free life. It will enable you to live purposefully, focusing on what truly matters. Your journey to financial independence is a holistic one. As you cultivate a wealth wisdom mindset, you enrich every aspect of your life, creating a legacy of abundance and fulfillment. Practical exercise: reflect on your financial journey. Take some time to reflect on your financial journey so far. Assess your progress. Review your financial goals and the progress you've made towards achieving them. Identify challenges. Reflect on any challenges or setbacks you've faced and how you overcame them. Celebrate successes. Acknowledge your achievements and the steps you've taken to improve your financial well-being. Set new goals. Based on your reflections, set new financial goals and update your plan to achieve them. Practical tip: share your financial journey and insights with others. Teaching and mentoring can reinforce your learning and inspire others to adopt a wealth of wisdom mindset. Embracing a wealth wisdom mindset is the key to achieving financial independence and a fulfilling life. You can transform your financial future by setting clear goals, staying committed to your plan, practicing mindfulness and gratitude, and continuously learning. Remember, financial independence is a journey that requires patience, resilience, and a proactive approach. Your financial future is in your hands. Embrace the wealth wisdom mindset and take the steps needed to achieve your goals. Dedication and perseverance can create a life of abundance, freedom, and fulfillment. As you conclude this journey through wealth wisdom, for starters, simple steps to managing your money, you will be equipped with the knowledge and tools to take control of your financial destiny. Each chapter has provided practical strategies and motivational insights to empower you on your path to financial independence. Remember, the journey to financial freedom is ongoing, and every step you take brings you closer to achieving your dreams. Stay committed, stay informed, and most importantly, stay motivated. Your financial success is within reach. Thank you for tuning in. Hit subscribe to stay updated with cutting-edge content and become part of our vibrant community. Your subscription helps us continue our mission to make learning fun and accessible. Join the conversation below and be part of a movement pushing the boundaries of what's possible. Let's learn, grow, and thrive together. Embrace the adventure of endless possibilities. Be well and thrive.